For 6 decades, Warren Buffett has operated on a single defining principle. His preferred holding period for a stock is forever. He generated multi-million% returns for Berkshire Hathaway by finding great companies and refusing to time the market. Over the last 12 consecutive quarters, that record changed. Buffett broke his own foundational rule, executing a systematic 3-year liquidation. He sold more stock than he bought for 12 straight quarters, pulling a total of $172 billion out of the market. To reach that number, he targeted his most prized assets. He slashed his position in Apple, a company he previously called one of the best businesses in the world, by more than half, selling over 41 million shares in a single quarter. Every dollar from those sales went into the safest, most liquid instrument available, short-term United States Treasury Bills. Over 3 years, the scale of this accumulation reached $314 billion in new cash. This chart shows the result. With a total stockpile of $373 billion, Berkshire Hathaway now holds more short-term U.S. government debt than the Federal Reserve itself. While the rest of the market stayed fully invested, the most successful investor in history liquidated $172 billion in equities and moved the proceeds into instruments that exist entirely outside the banking system. To understand why he abandoned the stock market for government debt, we have to look at the data he was reading. Short-term Treasury bills offer a unique advantage. They carry zero counterparty risk. By holding the actual security rather than keeping cash in a bank or a money market fund, Buffett ensured his capital remains unaffected even if the broader financial system faces a liquidity crisis. This chart tracks the Shiller-Cape ratio over the last century. When this metric climbs above 35, asset prices enter dangerous territory. In over a century of data, the market has only reached this level of extreme valuation once before, at the peak of the dot-com bubble. As asset prices hit these historic highs, the underlying economy began to decelerate. By late 2025, annualized GDP growth plummeted to 0.7%. Consumer sentiment crashed alongside it, signaling a growing disconnect between stock market valuations and the reality of the American household. This slowdown collided with a persistent inflation trap. Technology companies trading at massive earnings multiples rely on low interest rates to justify their prices. But with inflation remaining sticky above the target, the low-rate environment those companies need is not returning. Buffett compared the price of available assets against this stalling growth and sticky inflation. He concluded that the stock market no longer offered a return sufficient to justify the risk, especially while Treasury bills provided a risk-free 3.6% yield. These economic pressures are creating visible fractures in the financial plumbing. Private credit defaults have quietly surpassed 9.2%, crossing the peak default levels recorded during the 2008 financial crisis. U.S. banks are now sitting on $36 billion in unrealized losses, just as a wave of $930 billion in commercial real estate debt begins to mature. With national office vacancy rates exceeding 20%, much of that debt is facing a market with no appetite to refinance. This timeline shows that Buffett has followed this exact pattern before. He hoarded cash and faced intense criticism for being outdated right before the devastating bear market of 1969, the 2000 tech collapse, and the 2008 housing crash. During those crashes, his liquidity allowed him to dictate extraordinary terms. While every other institution scrambled for cash, Buffett was the only buyer in the room, securing high-yield preferred shares and warrants from companies like Goldman Sachs. This $373 billion stockpile represents the same cyclical playbook Buffett has run for 60 years. He waits for the system to fracture, ensures he is the only one left with liquidity, and prepares to deploy it at maximum distress. This massive cash position provides what analysts call crisis optionality. By holding short-term government debt, Buffett maintains a state of constant readiness, positioning Berkshire to act as the primary buyer when every other institution is paralyzed by losses. The mass of a market decline reveals why this is so effective. If the market drops 20%, a fully invested portfolio on the left takes the full hit. But the portfolio on the right, parked in T-bills, earns $13 billion in risk-free income while the decline happens. When the market eventually bottoms out, that cash is used to purchase high-quality stocks at 20% lower prices. This rebalancing generates a massive performance spread compared to investors who held their positions all the way down. It is important to note that Buffett is not predicting the end of American business. He still holds $267 billion in equities. He is exclusively bearish on the current price of those assets, refusing to pay a premium when the underlying fundamentals are deteriorating. You do not need billions to apply this logic. You simply need enough safe, liquid reserves to ensure you aren't forced to sell at the bottom, giving you the ability to capitalize on the opportunities that distress creates. By accumulating the largest cash position in corporate history, Buffett has positioned himself on the shore while the tide goes out. He is waiting for the seabed to be exposed, ready to buy the assets everyone else is being forced to sell.